Hi, my name is Jim Evans, President of Gannon Wealth Security Partners. Thank you for taking some time out of your day to watch our video. Our videos are to help you understand the strategies you need to help protect you, your family, your business, and future generations. Those strategies will be all wrapped around retirement planning, estate planning, tax mitigation, and asset protection. I hope you enjoyed today's video. Please don't forget, subscribe to our YouTube channel, follow us on Twitter, like us on Facebook, and make sure you leave comments below so that we know exactly what you want to know. That's what we're here for. Thanks again and enjoy today's video. Hi everyone, welcome back. Thank you for watching today's video. Today we're going to talk about using life insurance inside of an irrevocable trust. We're going to go over 6 benefits. We're going to explain how it works. So here we go. All right. So why use life insurance inside a trust? So let's say a client gifts $100,000 to an irrevocable trust. So we've brought that trust over here so that we can work inside of the trust. Here we have $100,000 inside of the trust. Okay, so what's going to happen here is what we would do is we would take a 10-pay or 20-pay policy, and we would do a whole life or a GUL, okay? Which again, I've brought this up in other videos. Essentially, what that means is you're going to pay for 10 years, and then you're done paying, and then the premium, the life insurance policy continues to exist beyond that 10 years. So, for instance, if we had $100,000, we could take $10,000 a year times the 10 payments, or 10 years. You could still pay it monthly, however you'd want to do it, right? So that equals the 100,000, and that's going to give us a death benefit of, let's say, it would depend on the age, but let's say that's 400,000. Okay? So we have a defined amount that we're putting into the premium, into the policy, for a defined amount of at least $400,000 in death benefit. Let's say this would be a whole life contract, so a 10-pay whole life contract. The reason you would use a whole life contract is if you would want to use, sorry about the phones, if you would want to use cash value inside of the policy in order to continue to purchase other assets. For instance, you take $10,000 out of the policy, let's say you get to year 4 and there's let's say $25,000 in cash value, and you want to take $10,000 of that out to put a down payment on a property, right? So you could use that cash. That's why you would want to use a whole life policy, if you would want to use the cash inside the policy. Now, however, you may want to do a guaranteed universal life contract, okay? So again, you could do a 10-pay, $10,000 a year, okay, for the 10 payments in the GUL, and that may give you a death benefit of $650,000. Okay, now, so let's go over, we're going to our income tax mitigation. So we had spoke about before that when you have an investment account inside a trust, an irrevocable trust, that trust needs to pay its own taxes. So if we assume that the tax rate on the trust is 40%, right? Now, if we invest this in the market, then we obviously have market risk, and we take $10,000 out. But let's just say it just sat there in a checking or savings account inside that was owned by the trust. There is no or very little income coming off of this, so you don't have any income tax liability, or a very small income tax liability. Now, the reason people like using life insurance is because if you use a whole life policy, that income, that cash value increase, and that dividend paid on the cash value that's inside the whole life policy is not income taxable. Okay? So you're not going to pay income tax on that. That grows tax-free inside of the policy. So that's why you're mitigating your income tax. You are putting in a vehicle that is going to give you a guaranteed rate of return, okay, on the death benefit, here or here, and you're not worrying about the income tax implications of the trust paying those income taxes. So that's this one here. Okay, you're maximizing your wealth. Here, that $100,000 could grow to $400,000 or $650,000, depending on how long that asset is inside the trust and how long you live and how long the trustee can continue to manage that asset and manage it well enough to get the rates of return. And also, again, If this was in a brokerage account, you would have to have some component of understanding that you're going to have to pay income taxes on those gains, or the trust is going to have to pay income taxes on those gains. So people like doing it because here they say, okay, I know I'm putting $100,000 over 10 years into the policy and I'm getting a guaranteed rate of return. Okay, I don't have to worry about whether the market goes up or it goes down. So let's just skip down to market risk is minimized. The reason I say it's minimized is because some people may choose to take that $100,000, put it into an investment account safely, try and get a little bit of rate of return. That way that not only are they putting into the premium, but they're also growing the money outside of the policy. However, you know, you are going to have market risk if this is going to be in a brokerage account. Even no matter how safely you invest, you have to be concerned about market risk. So using a life insurance policy minimizes this market risk. Okay, so you're maximizing the wealth because you know exactly how much the death benefit is going to be. Because the policy is owned by the trust and payable to the trust, the death benefit is going to be outside of your estate. If you saw in an earlier video, we did talk about the fact that if you have a personally owned life insurance policy in some states, that death benefit will not be income taxed, but it will be taxed on potential death taxes on your estate, whether that's a state estate tax or that's a state inheritance tax. So having this death benefit in the trust outside of your estate, you're going to minimize, or you're going to mitigate completely any death taxes on that death benefit. Okay, so that takes care of that one. Cash value grows tax-free. So as we used here in the whole life policy, as the years go by and the premiums are put into the policy, the cash value is going to go up. This dividend that's being paid to the cash value is not income taxed. Okay, so it's growing tax-free in a whole life contract. In a guaranteed universal life contract, you have minimum cash value. So people that are buying a GUL or a guaranteed universal life contract, they're really purchasing that to maximize death benefit, and they're not really utilizing the cash value or utilizing the policy to have liquidity in it. So between these two, you have to measure up your objectives and see which one is going to be better for you. Okay, and the known rate of return. I talked about this a little bit earlier. I alluded to it. But here I know exactly how much I'm putting into the policy, and I know exactly how much my death benefit is depending on which policy I get. Those types of known rates of return, okay, are not exactly possible in the market. You can say, okay, some years I'm going to get 2%, some years I'm going to get 4%, some years I'm going to get 8%, some years I'm going to lose money. So when you have the money in a brokerage account, even no matter how safely you try to invest that or have an advisor try and invest that money, you don't know exactly how much you're going to get. Here, you do. Okay, whatever that death benefit is, you know that's going to be paid to this trust upon your death, and you know exactly how much you're growing this money into. So that is a down and dirty, quick and easy way of looking at why people use life insurance inside a trust. If you have questions, you can always reach out to us. Number here is 718-704-0900. Even if you just have questions. Doesn't mean just because you call us, you got to buy a policy, okay? It's not salesy. We want people to have the information. We are passionate about people utilizing strategies that are going to increase their wealth, increase the amount of money that they're going to get to the next generation, decrease the liability of estate taxes or death taxes, and decrease that income tax too. So we have to understand what vehicles are going to work, how they're going to work, and understanding why you would use which one in which situation. So I hope you liked today's video. We made it quick for you. Again, follow us on Twitter, like us on Facebook, subscribe to our YouTube video. We're trying to get more of an awareness out there that there's this information that we're just giving out to the public. We're just providing that information to people because we want people to have the information that they can utilize and understand to work with their current advisor, to find an advisor that makes sense for them, and that's going to show them the strategies that's going to help them grow their money safely, securely, protect it, and also be able to transfer it easily to the next generation. So I hope you liked today's video, and we'll see you next time.